Hello, this is Donald Mitchell. Once again, welcome to Finance Magic Presents video snippets from Less Pain, More Gain, 10 strategies to pay off your mortgage faster, plus other smart tactics. We're still on the origins of Finance Magic, topic 1. And this video snippet is taking us from the Finance Magic booklet to the present. I've indicated the purpose of topic 1 is to illustrate my qualifications for presenting the material covered in these video snippets, and also share with you the origins of the name, Finance Magic. The last snippet about the Finance Magic booklet explained the roots of the name Finance Magic, which dates back to the early 1990s. The concept of the Finance Magic booklet as a tool for loan officers faced some challenges. The first one being that the lending rules kept changing, and the second was the introduction of computer underwriting, which stretched the qualifying ratios. You can imagine that when you print a booklet based on one set of rules, and they change the rules at least once a year, that the booklet has a short life before it becomes obsolete. And if you're trying to pre-qualify somebody based upon qualifying ratios, and computer underwriting throws those ratios out and will stretch them, you can't rely on the numbers. And in fact, the lending industry soon learned that instead of pre-qualifying somebody based on ratios, you should actually get them pre-approved by running them through the computer underwriting. That way you would know exactly how much a borrower qualified for, and you had an approval. The creation of the Finance Magic book gave me a reputation as a spreadsheet programmer. I was contacted by an entrepreneur who wanted to create an infomercial on the FHA 203K loan program that provided funding not only to buy a house but to fix it up. I created the software product, which I labeled Rehab Magic, and it worked, but unfortunately the entrepreneur never got the funding to do the infomercial. I was also contacted by the Money Store Commercial Loan Division, which was the largest SBA small business commercial lender in the nation, and they had me do some spreadsheet programming for them, and then they offered me a job. I became a senior SBA loan officer underwriting SBA small business commercial loans. I also was put in charge of the rollout of the new SBA environmental due diligence policy, and I had to train all the business development officers and other loan officers and make sure our policy was in compliance. They later made that a permanent position for me as I supervised the lender environmental due diligence policy for loans in all 50 states. The Money Store was bought out by First Union Bank, which is now Wachovia, and they had a strong environmental department, but I didn't want to move to corporate headquarters. So I gave notice and joined the industry where my wife was working. She became a site acquisition specialist to locate leases for cell phone towers. I became a zoning specialist. We moved our residency to Las Vegas, and we also formed a Mitchell & Mitchell LLC with the idea that we might someday be able to bid on cell phone tower contracts that she could arrange leases for and I could get the zoning for. But that industry imploded when the stock market corrected in 2001. The cell phone companies were financing their tower build-out by floating stock issues. So I obtained a securities license and became a licensed financial advisor. I quickly figured out that I didn't agree with the basic financial planning theory I was licensed to practice because I thought it was likely to fail clients, and I knew I had made a mistake. The buy and hold theory of investing was much riskier than the industry was letting people understand. I switched gears and let my licenses lapse, but that started a personal quest to identify a better, less risky solution to the financial planning investing challenge. I returned to my mortgage roots. I registered as a loan officer affiliated with Debcon Mortgage. I continued marketing the Finance Magic booklet to a variety of lenders. I became a part-time instructor at the Money School, training other loan officers. I served as a qualified employee for Debcon Mortgage and headed their loan processing department, supervising the loan processors. Then I attended a strategic equity conference located here in Las Vegas. At the conference, I learned about a new mortgage specialization called mortgage planning, and later qualified as a certified mortgage planning specialist. All of the speakers at the conference seemed to be raving about a new book titled Missed Fortune by Douglas Andrew. And then Douglas Andrew spoke. He talked about investment-grade life insurance contracts where your cash value accumulated tax-free, that you were able to get most of the gain of the stock market when the market went up and had none of the losses when the market went down, and that you could access your funds tax-free. And when you died, the life insurance settlement passed through your estate, but then on to your beneficiaries, income tax-free. And Mr. Andrew represented that he personally had received an average rate of return since the 1980s on his investment-grade life insurance contracts in excess of 7%. As I said in the audience, I realized that if what he had said was correct, he had identified a solution to a less risky way for long-term financial planning. When I was licensed as a financial advisor, I was also insurance licensed. I wondered why I had never heard the term investment-grade life insurance contract. I knew I had to get to the bottom of this, so I signed up to get personally trained by Douglas Andrew in a 3-day course. I learned that you're not supposed to use the word investment when you talk about life insurance. Alternative words that can be used include maximum funded, optimized, or tax advantaged. I learned the trick was to do things backwards from the way life insurance is normally sold, where you figure out how much coverage you need and then shop for the lowest premium. Instead, you figure out what funds you have to invest and purchase the least amount of life insurance coverage the law allows to maintain the definition of a life insurance contract and get the benefits that are offered. Your tax-free cash value will grow the fastest if it's bleeding insurance costs out the least. I determined to reacquire a life insurance license, not because I wanted to sell life insurance, but because I wanted to be able to offer the benefits of the product to my clients. In my search for a better investment approach to assist people planning for retirement, I started looking at mortgage acceleration strategies, and I began the conceptualization for a book. My wife, Nancy Walker Mitchell, came up with the title, Less Pain, More Gain, 10 Strategies to Pay Off Your Mortgage Faster. We decided to collaborate. We are trying to release the material in video snippet format because I think the ability to illustrate using dynamic spreadsheets will communicate the power of the various strategies more effectively than static charts one would have to place in a printed book. As a listener, you are a guinea pig. Can I teach you the strategies more effectively with these video snippets? If I am correct, these video snippets are likely to make a difference in your life. One final item before concluding this snippet. In 2008, I was stunned by the amount of bailout funds being thrown at the economic crisis. Based on the solutions being implemented, it looked to me like we were on a course to bankrupt the country without actually solving the critical cause. And it looked like the government didn't know how to solve the problem. I knew there would be no real recovery until the price of real estate increased sufficiently to clear the value of most underwater mortgages. I reasoned that a solution needed to have the qualities of removing bank-owned homes from the pricing action of the real estate market. My goal was to conceptualize a solution that could be self-financing once initial seed money was invested, rather than rely on taxpayer-funded bailouts. I incorporated some of what I discovered in my research on the Less Pain, More Gain book to structure an economic proposal that met the qualities I was seeking. The proposal was based on creating a new bundle of real estate rights that I labeled a rent-to-own contract, or an RTO contract, that could be securitized. My goal became getting the concept test marketed in the 5 worst areas of the country. I got as far as getting an invitation from the director of the local HUD office to submit a 1-page proposal for a consulting contract to support completing the concept to the stage of being able to test market it. Unfortunately, that letter was never responded to, and I couldn't afford to continue to work on the proposal without an income. This concludes video snippet 1C that takes you from the Finance Magic booklet to the present. Tomorrow's snippet will start on topic number 2, the lending rule changes, and snippet 2A will be an overview of those changes. Thank you for listening.